right now. While you're watching this, someone's bank balance just dropped by $35. They didn't buy anything. They didn't transfer money. They didn't even notice it happen. It was a fee. And somewhere inside the bank's annual revenue forecasts, fees exactly like it were already accounted for, long before it happened. Not illegally, not by accident, by design. It's sitting in a document they signed years ago and never opened again, buried somewhere around page 14, in language dense enough that almost no one reads it twice. By the end of this, you'll understand exactly how a handful of words in a disclosure document quietly generate billions of dollars a year, and why almost nobody notices until the money is already gone. This channel exists to show you what's happening behind the scenes of your own financial life. If that matters to you, subscribe, because what we're about to open next might surprise you even more. Every bank account comes with a document nobody finishes reading. Somewhere inside it are the fees, overdraft charges, foreign transaction fees, a maintenance charge that appears only if your balance drops below a number you were never told to watch. None of this is secret, legally speaking. It's disclosed. That word does a lot of work. Before we go further, we want to know something. Have you ever been charged a bank fee you didn't understand? One that just showed up, unexplained, until you had to call and ask why? Tell us in the comments. We read everyone, and some of the most revealing parts of this story come from you. Start with the most common one, the overdraft fee. On paper, it sounds almost helpful. The bank covers a purchase you couldn't quite afford and charges a fee for the service. A safety net, dressed up in reasonable language. But look at how the number is set. The average overdraft fee in the US has hovered around $35, often charged against a shortfall of $5, $10, sometimes less. The fee isn't proportional to the mistake. It's a flat charge, calibrated not to the size of the error, but to what the market will tolerate without enough complaints to matter. That's not a guess. It's a pattern regulators have been watching for over a decade. In 2009, the Credit Card Act tried to close some of the worst of this, banning certain retroactive rate hikes, requiring clearer disclosures, reining in the most aggressive fee practices on credit cards specifically. For a while, it worked. Complaints dropped. But then something changed. The act regulated credit cards. It never touched checking accounts. And checking accounts still had plenty of room left to generate revenue the same way. If that timeline just reframed how deliberate this feels, that's exactly the point of this channel. The like button helps this reach the people paying these fees without knowing why. It takes 1 second. Picture a Monday: coffee, $6, lunch, $12, gas, $28, groceries, $90. 4 purchases, same day, against a balance of exactly $100. Processed in the order they happened. Maybe 1 purchase overdrafts, maybe 2. But for years, several major banks didn't process transactions in the order they happened. They processed the largest one first. Run that same Monday through that rule, and the $90 grocery run hits the account first, draining it instantly. Now the $28, the $12, and the $6 purchases all overdraft, one after another. Same spending, same balance, 4 fees instead of 1. This wasn't a technical accident. It was litigated. Several major banks paid hundreds of millions of dollars in settlements over exactly this practice. After courts found the reordering wasn't a processing necessity, it was a choice that measurably increased fee revenue. But here's the part that changed everything. Banks weren't just collecting these fees when they happened to happen. Some were quietly rearranging the order of your own purchases to make sure more of them did. This is where the story stops being about bad budgeting and starts becoming about business strategy. Internal bank projections for overdraft revenue aren't rough estimates. They're modeled and forecasted, built into annual revenue targets the same way a retailer forecasts holiday sales. The Consumer Financial Protection Bureau has increasingly flagged charges like these as junk fees, costs that don't map to any real expense on the bank's side, but persist because avoiding them takes more effort than just paying them. The industry doesn't lose money on your mistakes. It budgets for them. In some years, Overdraft and related fees have added up to tens of billions of dollars across the U.S. banking industry. Not a rounding error, a recurring line of revenue. That's the shift most people never make. A fee doesn't feel like a business model. It feels like a personal slip-up, something you should have caught. That feeling is doing exactly what it's designed to do. It keeps the anger pointed inward, at yourself, instead of outward, at a system engineered to profit from a moment of inattention. To be fair, not every fee is predatory, and not every bank runs on this model. Plenty of credit unions and online banks have moved toward no overdraft, no minimum balance structures, partly because customers demanded it, and partly because regulators started watching more closely. The system isn't purely evil, it's just been designed for a long time in its own favor. But imagine what this looks like for someone living close to the edge of their balance. A single mother whose account slips $10 into the negative on a Monday morning. By Friday, that $10 shortfall has quietly multiplied into more than $100 in fees. Each one triggered before she had the chance to notice the first. The original shortfall wasn't what hurt. The fees were. Federal Reserve consumer finance data has consistently shown that lower-income households are far more likely to carry accounts with frequent overdrafts than higher-income ones. The fee that costs a wealthy customer nothing more than mild annoyance can cost someone else their ability to make rent that month. Debt isn't built in one bad decision. It's built in 100 small, forgettable ones, and fees are engineered to live in exactly that blind spot. Pause for a second. Open your banking app. Scroll back 1 month. How many of those fees do you actually recognize? The good news is this particular trap has more visible seams than most. Overdraft coverage, in nearly every case, is opt-in, which means it can be turned off, turning a declined transaction into a simple inconvenience instead of a $35 lesson. Most banks now offer low balance alerts that warn you before a shortfall happens, not after. And fee-free checking through credit unions or newer online banks has gone from a niche feature to an actual selling point because enough people started asking for it. None of this requires a financial overhaul. It requires knowing the mechanism exists, which, until a few minutes ago, you might not have. The next time $35 disappears from someone's account, remember, it probably wasn't because they spent too much. It was because the system is built so that forgetting can cost money. The fee doesn't feel like a fee. It feels like a mistake. That's the design. So we want to know, is there a fee sitting in your own bank statement right now that you're going to go check the moment this video ends? Tell us what you find. Let's compare notes. Next time, we open a different file, one about a number that follows you into every loan application, every apartment lease, every job offer, and that most people have never actually seen calculated. Just told what it is.